All right. So today's presentation again is about financial strategies to review and then really to hammer so we can have the most successful end of our year. Throughout today's presentation, if you have any questions, comments, concerns, please interact with me in the chat box. I'll keep an eye out. Would love to answer your questions and chat with you in real time as we go through this today. The disclaimer, as always, is please interpret this as education. We're big on financial empowerment through education and literacy. However, we don't want you to consider the things that I say to be financial advice. There's no way I could give you financial advice without knowing more about you personally. If you hear some things of interest, take these concepts, talk to your advisor, and see if these things do make sense and are in your best interest financially. Without any further ado, let's jump right in. And here's where we're going to go today. We're going to talk about why year-end planning matters. We'll talk about your financial review, cash and debt management, retirement and investment moves, benefits planning, tax planning, and then we'll wrap up with a bit of an action plan. So those are the things that we're going to cover. It's going to be quite a bit, and I'll move along at a decent pace so that we have plenty of time for Q&A. And again, feel free to stop me, type something in the chat box, and we'll talk together as we go throughout the presentation. So the reason we're talking about this at all is because certain things only matter if they happen within the calendar year. So I haven't counted how many days we have left, but we probably have somewhere in the neighborhood of 75 days left in 2025. There are some really important things that you could do now or before December 31st is over that could benefit your financial situation almost immediately. But then, more importantly, some of the things you might do could be building blocks that you would continue to build on in 2026 and beyond that could have a compounding effect on your overall financial satisfaction and financial success. So those are the things we're talking about today. Those quick return on investment moves you can make, but then also the building blocks or foundational items that can lead to increasing levels of success year over year over year. The first thing I would encourage you to do is just reflect on how far you've come. I mentioned that there's only about 75 years left in the calendar, 75 days left in the calendar year. That means almost 300 days are over. So just sitting where you are today, thinking back on the year, how did it go? How do you feel about it? I know there were times this year when I thought, whew, things could get a little squirrely, and they did. Government shut down and other things. But truly, just think about where you are and what's gone well, and maybe where we could improve upon things. Often folks tell me what their goals are, if you look back at your year's worth of spending and habits, you can pretty much clarify what goals were really important because you'll be able to see the proof of what you did or didn't do. So again, the end of the year is a good time to make decisions, but also to commit and recommit to priorities and changes in the future. So one of the places I always recommend starting is just your current location. Financial planning is as simple as knowing where you are today, figuring out where you want to go, and then drawing the line between the two. Cash flow is one of the biggest, most important things for most of us to think about. So, once upon a time, which probably is still true this year, my wife and I sat down and we did a family finance day. And it's really simple. Pull your bank statements, pull your credit card statements, and just go line by line. Pick any month. And for us, dining out was a little bit of a problem area for us in 2025. I won't tell you how much we spent on it, but it was a lot. But it took us actually pulling our statements and going line by line and highlighting and adding to go, this is not okay. And we need to make some adjustments. So just being real about your cash flow is a really important thing. As much as cash flow is important, the money in the bank is also important. So sometimes money in the bank is too high, sometimes it's too low. Both of those tell us important changes we might want to consider. For some of us, the money in the bank is just right. And that could also mean one, hey, things are working perfectly. Or two, if you'd like that to grow, maybe some other adjustments are needed. Debt management is an important part of the equation, especially if you have something like a home equity line of credit or some type of variable interest debt. Recently, we've seen interest rates have gone up substantially. So if there's anyone out there that has a home equity line of credit and maybe you haven't looked at it the last year or two, I would just encourage you to take a look at the interest rate because right now it's probably significantly higher than it once was. If the interest rate goes up and your HELOC or home equity loan payment doesn't go up, you might be paying a lot less to principal than you think. So then that interest could stick around for longer than planned. There's been comments recently about the 50-year mortgage. We don't want to have a 50-year payment on a big screen TV. So we've really got to check how much money is going to principal and interest so we don't sometimes end up paying $5,000 for a $1,000 purchase. So just reevaluating the current debts you have could be a good strategy. Often retirees will tell me, "Hey, you know what? Even though I'm retired, I don't want to pay off the mortgage. I want to leave my mortgage alone because I want to take the tax deduction." So I'm going to throw out a quiz question to the group. Of all the Americans that file taxes, what percentage do you think actually benefit from writing off the interest on their mortgage? So I want you guys to give me a real answer. I'm going to say this one more time. Out of all the Americans that file taxes, what percentage actually benefit from itemizing and using their mortgage interest deduction? So Ronald says 30%. Okay. Any other takers? What percentage of people actually benefit from having a mortgage? Because I hear this pretty often. People say, "Oh, I don't want to pay off my mortgage because I'm getting a tax break." Diane, 10%. Shelly, 8%. Yeah, it's in the 8 to 10% range because 85 to 90% of Americans claim the standard deduction. What that means is all your itemized things, waste of time, didn't help you at all. So, yeah, there's maybe a 10% chance that your mortgage will actually help you save money on taxes. So that's a good guess. That's a very good number. The reason I say that is if you're someone who has been holding on to a mortgage that maybe you don't actually want, but you think is benefiting your taxes, have your advisor look at your tax return. And if you're claiming the standard deduction, this is your sign to let that mortgage go because it's not actually helping. So thank you for playing. Great answers. 10% or so, that's about right. The other 90%, having the mortgage doesn't help at all because we're claiming the standard deduction 9 out of 10 times. Goal progress. The end of the year is another good time to just check where you are. We run analysis with clients where we'll explore their goals and we'll say, "Hey, you're 90% on track, you're 100% on track," or whatever the goal is. At least once a year is a good time to do a sanity check to see if you're still on track. If you're still on track, that's usually a good thing. If you're on track or above track too many times in a row, we start to have more detailed conversations about, if enjoyment of life isn't increased by spending more money, what do we want to actually redirect these dollars for? Often we see folks become more charitably inclined, or they just want to give to their kids or grandkids more while they're living. So continue to check in on those goals just to see, we had a plan to start 2025. How are we doing as we get ready to land the plane and move on to 2026? Another thing to just check in on is during 2025, were there any windfalls or surprises? Windfalls could be you scratched off a ticket and won, 50,000 bucks or $1 million. If there's any Mega Millions winners on the line, please DM us later at your team at IWB.com. But maybe there were things that set you back. Maybe there was a one-time expense like a wedding or helping out a child or a grandchild with a new car. You just want to factor those things into your overall plan to make sure that as we're running analysis, that those things are accounted for. With cash flow planning, I mentioned earlier that just having enough left over can sometimes be a challenge. Statistics say about half of American households are feeling like they're living paycheck to paycheck. So it just comes down to trying to figure out how do we cut some expenses, maybe increase income, and then how do we automate savings? there's apps now where once a week you can have $5 move over to a savings account, or you can round up to the nearest dollar and round up the change. All these things can be great ways to just bulk your savings and continue to build without it feeling like a very heavy lift. So one of the challenges that I have for everyone is
Rest.
between now and the end of the year, just go through your expenses and see if there's anywhere that you could find that you could immediately save some money. In our household, we were paying for a couple different Hulu accounts and we kind of forgot. We didn't notice. We also had a duplicate Adobe account where we're paying for multiple Adobes that we didn't really need. Again, just going through your bank account statements, your credit card statements, that can be helpful. There's also tools like Rocket Money and other tools that can help you see if there's duplicate transactions or subscriptions you may have forgotten about that you may or may not want to cancel. So we mentioned debt earlier. Again, debt has been a tough thing recently. With interest rates going up, it's harder to buy a house. It's harder to sell a house and move to a new house because the interest rates, but then also the home prices. Buying a car, rates now are 6, 7, 8, 9, 10% sometimes. Um, Everything just is a little bit tough with interest rates being higher. So where you can, you may want to consider things like refinances. Back in the day when cars were at 0 or 2%, making a small down payment was maybe a good idea. But in time frames like this, especially if you're not a super aggressive investor, maybe it is a good idea to make a bigger down payment, or for some people, even to buy a car cash. So the truths about money and the best practices, they vary based off of economic factors like interest rates and all sorts of things. So just continue to check in. As you review your balance sheet, which is your assets and your liabilities, just ask yourself, is having a car payment at 7% a good thing if I have money in the bank that's only earning 1%? Or maybe that it's even earning 3% in the bank. Is it better to earn 3% in the bank if you're paying 7% in interest? I don't know. I think this is a good time for another Ask the Audience. So, audience, I want you to be my financial advisor. I have $50,000 in the bank and I owe $40,000 on my car. My bank account is earning 3%. My car is at an 8% interest rate. What should I do? Should I pay off my car and reduce my savings? Or should I just leave the savings and not pay off the car? Again, the car's at 8%, the bank account's earning 3%. I've got a $40,000 car loan and a $50,000 amount in my savings. Just curious what you all think. Some of both. Okay, Shelley. So that's an interim somewhere in the middle. Maybe we reduce the savings some and then knock off some of the balance to reduce the interest. Okay. Any other takers? Does anyone else say, this is my question. Does anyone think take 40,000 out of your emergency fund and just pay off the car? Would anybody do that? We'll call this honesty hour. If anybody thinks they would do that, the tax implications. Let's assume the tax implications are pretty much nothing because the money in the bank, if it's earning interest, you're paying taxes anyways. So taking the money won't have any impact. Okay, so I see a couple no's, sell the car, reinvest what's left over. I like cars, but they're a sore spot because they're a depreciating asset. And in my life, I like assets that go up in value, not assets that go down in value. We shouldn't even call a car an asset. Um, Pay off half the car. Flip says pay off the car. Honestly, paying off the car is not a bad idea. Here's the reason. In most situations, if there's a real emergency, you could take a loan later. And if you take a loan later, if the car's at 8%, I don't know, there's a decent probability you could get a loan at the same interest rate or maybe lower. So yeah, it all depends. If you have bigger reserves, paying off the car, if it's at 8%, probably a good idea. But if you do not have as many reserves and maybe you don't have a really high credit score that can get you low interest debt, then not paying off the car probably is a better decision. So yeah, again, thanks for playing. It's all a bit of it depends. But as interest rates change, as the national debt changes, as tax rates change, We have to be nimble so we can continue to make the best decisions for each of us. So we'll talk quickly about some of the tactical year-end things that you can take advantage of. One thing is just maximizing your investments. If you have a 401k, 403b, 457, TSP, IRA, many of these things you'll want to, if you want to max them out, you have to do it before the calendar year's over. Now, for the IRA, that's not true. You have until you file your taxes, which could be April or October. For self-employed, again, you can wait a little bit longer. But for especially things like a 401k, you may want to do that sooner than later. Maxing out a 401k can be an excellent idea if it immediately gives you credits to offset your taxes. Here's an example. One of my clients earns $415,000 per year. Because they're over $400,000, instead of getting $2,200 per child as a credit, they actually lose a portion of that credit because their income's too high. They end up only getting $700 per child. If you have four children, you just lost $6,000 of a credit, which is a dollar for dollar reduction of your taxes because your income was too high. For that family, putting more into the 401k to get below the threshold of 400,000 could immediately put $6,000 back into their pocket. They also reduce their taxable income by 15,000 and they have more money in retirement. So again, it depends on your situation. If putting away more money can not only save you taxes through deductions, but also by giving you credits back that you might have lost, may be a good idea. Every year, there's people that have to start RMDs. Those are required minimum distributions, or we call it the required beginning date from your IRA or 401k, etc. The rule states that the year in which you turn 73, you have until the following April to take your first distribution. So let's say if there's someone that's 73 on the line today, they don't have to take a distribution right now, but by April, if they turn 73 this year, they have to take their first distribution from their retirement account. Now, here's the thing. If you wait until April, you take the distribution, and then you have to take another one before December, or else there's a penalty. So, long story short, if you're 73, you may want to take a distribution in 2025, knowing you have to take another one in 2026, because you don't want to take double distributions in one year, because that could have some bad tax impacts. Your personal tax bracket could go up, your Medicare payments could go up. There's all sorts of nasty things that could happen. So, special notice if you're 73 this year or you're in your first year of taking required distributions, ask your advisor, should I take a distribution this year or should we plan to double up next year? Really important timing thing that you have an opportunity to impact before the end of 2025. Another couple things are just to consider Roth conversions, which is going from traditional IRA to Roth IRA. Um, every year that you have a Roth is good. So even if you have a Roth with just $1, you're adding to the 5 years of Roth you need to take tax-free distributions once you're over age 59 and a half. So whether you convert to Roth or you just open a Roth just to get credit for 1 year, doing so before the end of the tax year could be a good move for you. Lastly, rebalancing your portfolio at least every 3 to 6 months is a good idea. Rebalancing is simply selling certain things and reinvesting in other things. In retirement accounts, you can do this at any time with no tax impact. But for non-retirement accounts, you have to be aware of the taxes. You may even be able to sell some things so you can take a tax deduction up to $3,000 off any of your earned income. Again, this could sound like some other language. It's called tax loss harvesting. Again, could be a good thing to chat with your advisor about if you have non-retirement assets and just say, hey, should we take any tax losses before the end of the tax year? I'm going to keep on rolling, but I know I'm saying a lot. So if there's anything that you want me to pause on or you have a question about, let me know. Um, I thought this had the slide numbers on it. I don't know how many slides are left. So I'll try to talk at a decent pace so I don't keep you all here for 2.5 hours. So again, if you have any questions, just pop it in the chat box and then I will keep a lookout and then we'll talk. Every year, it's a good time to just consider your benefits. If you're still working, This is a good time to look at flexible savings accounts, health savings accounts, getting more or less life insurance at work or outside of work. Um, Overall, every year with open enrollment, it's just a good time to reassess what you're currently doing and to see if it's a good time to do something different. I'm going to pick on life insurance for a moment. When you have life insurance through work, if you're in your 20s or 30s, maybe 40s, really cheap, usually a good idea. As you get into your 50s and 60s, it can get pretty dang expensive. So, again, if you're in your 50s and 60s and you have a bunch of life insurance through work, double check your pay stub, make sure you're not paying more money than you think, because you could actually save money if you're healthy by getting a personal policy outside of work where the policy price is based off of your health versus just the aggregate health of a group of representative individuals in society. So again, benefits every year is a good opportunity to take a look at them. Life insurance specifically, as we get into our 50s and 60s, could be a good time to consider switching from a employer plan to a personal plan. In your 30s and 40s, could be a good idea as well. The better your health, the more money you likely save by getting your coverage outside of work. So let's answer a question. So Flip says, if you have a Roth account for a period of 5 years, it can be used as an avenue to stream funds out of a traditional 401k. Um, so let's talk about that. Let's say you have a Roth account and yep, you've met the 5-year rule and you're over age 59 and a half. That means that any money in that Roth IRA you can take out tax-free, penalty-free, and spend. However, if you then take a traditional 401k and you convert it to the Roth, technically the conversion has a separate 5-year clock. So when you convert from traditional 401k to Roth IRA, the money you converted actually has a new 5-year clock that you have to honor. Roth IRAs have something called an ordering rule. Any of your contributions come out first, then the money you converted comes out next, then the earnings come out last. So generally, people don't run into a lot of trouble with Roth IRAs unless they do a big conversion and take a lot out immediately. But the 5-year rules can be a little bit convoluted. So just be careful with converting pre-tax money to Roth. The 5-year rule does apply, but there's two different 5-year clocks. They don't make it easy for us. But thank you for that question. If there's any other questions, let me know. I'm here all week and here in our boardroom at IWB, as you can see. Let's talk quickly about Medicare and Social Security. I say quickly because we could spend 45 minutes on just one of these topics. Again, with Medicare, every year is an opportunity to make adjustments. That could be adjustments such as if you're doing Medicare Advantage or Medicare Standard. It could be changes in supplements or the Medigap policies that you're claiming. So those are just year by year things. How did the last year feel? Were you able to get all the care you needed? Was everything up to your satisfaction? If not, maybe we want to consider some differences. Social Security, for folks that are already receiving Social Security, it looks like we'll have another COLA this next year. Won't be a ton, but it will be nice. The big thing I mentioned about Social Security is there's a formula that dictates what percentage of your Social Security is taxable. Every year, you're in charge of how much of your Social Security is taxable because you can control your income by taking distributions, by not taking distributions, by taking certain tax deductions. So just know that with Social Security, it can be taxed at 0% or 85% of it can be taxable as a worst case scenario. But there's something called provisional income, which you can kind of control by deciding where to pull income from in retirement. So again, if you've never looked at this, might be worth considering looking at your tax return, looking at your adjusted gross income, calculating your provisional income, because generally the Social Security is taxable 0% taxable, 50% taxable, 85% taxable, or somewhere in those ranges. So again, making some proactive decisions could sometimes save you money by reducing your taxes on Social Security and putting more money into your pockets. And for those of you who have not currently claimed Social Security, a couple quick tips. One generally takes about 10 weeks from when you file it to get money in your pocket, sometimes better, sometimes worse, often worse. Part two, if you want to claim your Social Security to start, let's say February 1st, just know you're not getting a paycheck in February. If you start at February 1st, your first check comes in March. And it comes in March based off of the day of which you were born. Someone born on the 7th receives their money a different Wednesday than someone born on the 27th. So there's all these little nuances with Social Security. You can claim it forward, you can claim it backwards, you can do backflips. Again, we're here to help. If you have specific questions about Social Security timing, spousal benefit integration, etc., just let us know. We can help you with those types of things. You're welcome to go to your Social Security office. Unfortunately, sometimes you'll get the wrong answer and then you'll come back and ask us. So, yeah, save yourself some time. Just ask us on the front end and we're here to help. Some planning with taxes or tax planning for those that read left to right, not right to left, like I do. Tax management is all about just speeding up deductions or pushing off income or some combination. We can ultimately control our taxes by either accepting income or pushing it away and accepting deductions or pushing them away. And a lot of these things are in our control, whether we know it or not. So the timing of how we use money, where we put it, it's often up to us. So through strategic planning, you can take control of your taxes and create better outcomes for yourself. Now, with the One Big Beautiful Bill this year, there's quite a few things that are changing, from solar tax credits going away to electric vehicle tax credits going away to changes to above the line deductions for charitable giving. And, if you live in a high tax state like California or I mean, Massachusetts, the SALT deduction, which is the state and local tax deduction, could save you a bunch of money this year. I would just say if you haven't considered or talked to your accountant about the One Big Beautiful Bill and how it impacts you, might be worth talking to your accountant about maybe before year end so you can make some of these timely adjustments to take advantage of some tax savings you might be in line for. Again, varies from state to state to state, but generally there's a bunch of things that changed. We do have a one pager if you want it, that we can send to you that summarizes some of the changes from the One Big Beautiful Bill. If you do want that one pager, shoot us an email at yourteam@teamiwb.com. And if you want, you can just put in the subject or in the body OB3A, and then we'll know to send you that one pager. So it's pretty helpful, and it gives a good breakdown of some of the changes for this year. So let's talk a little bit about charitable giving. Charitable giving is an amazing thing when you have enough resources or you just feel compelled to share your resources, regardless of how much you have. And one of the cool things is, in addition to just giving, there's ways to give efficiently and there's ways to not give efficiently. I would submit to you that giving cash is almost always not an efficient gift. If you have the option between giving cash and giving a stock, typically you're better off giving the stock because the stock has some embedded taxes in it. So if you sell it and give it, you're paying taxes. Whereas if you just give the stock, you don't pay any taxes. So, real life example, I invested $1,000 into a stock. That stock grew to $5,000. I gave the $5,000 to charity. Well, by me giving $5,000 to charity, I'm able to take a $5,000 tax deduction. If I'm in the 30% tax bracket, that's a $1,500 tax savings. But like I said, I only put $1,000 into that stock that went really well. So by me giving away money, I actually kind of made money. Yes, it was less than the money that I could have made if I just sold it and kept it myself. But that's a pretty cool thing that you can give away highly appreciated stocks, take a big deduction, and the nonprofit or the organization that you donate to, they don't pay any taxes either. There's other things you can do where you can gift money from your IRA. There's all sorts of things. Donor advised funds where you can take a $300,000 deduction in 1 year and then give over the next 30 years. Granted, there's some tax laws and some rules. But there's some pretty cool things out there. So if you're in a situation where you're currently giving or you want to proactively give in the future, this is another good thing to chat with your advisor about and say, hey, are there any of these, cool tax savings that I could take advantage of to continue to give or to start to give in a way that's tax efficient, but then also going to give the biggest benefit to society or the organization that I care about? We'll talk for a moment about estate planning. This isn't really a timely year-end thing, but it's timely in that we don't know when our last days are. So it's always a good idea to think about reviewing and updating your beneficiaries, to review your will and trust, to consider giving as a part of your estate planning strategy, and to just plan for and stay tuned into tax and federal changes. For some folks that have a bunch of money and they're worried about estate taxes, one of the best things you can do is give gifts while you're living. You can give money to anyone you want, and as long as it's below a certain threshold, it doesn't count as money you actually gave away. It doesn't reduce your lifetime estate tax exemption. So again, if you're someone who is has enough resources where you don't think you'll ever spend them in your lifetime and you're worried about estate taxes, figuring out a giving strategy while you're living could be a great idea. And again, those are the types of things that we can help with. But generally, the best practice here is just review your beneficiaries, make sure they're up to date. If you have bank accounts, make sure there's a beneficiary on file. Otherwise, bank accounts and other things you own can go to probate, which is a horrible process sometimes. It's a very public process. And if we can avoid probate or help you avoid probate, we typically would say that's the best thing to do. Insurance is something we talked about earlier. With the year coming to an end and you're looking forward to 2026, could be a good time to rethink your life insurance, your disability insurance, your auto, home insurance, or your health insurance. So here's an example. Let's say you've had homeowners insurance and 5 years ago, you got a policy and it was a $300,000 policy. Well, over the 5 years, your house may or may not have increased in value. So if it's been a while since you've updated your policy, might be worth checking. Because let's say your policy is 300,000 and your house is worth 600,000 and a flood happens. Your house is not fully covered anymore because you were supposed to increase your coverage as your home value went up. So if a flood happens, they're not going to pay 100%. They're only going to pay a portion of the loss based off of you being underinsured. So checking your homeowner's insurance, your auto insurance, at least annually, those are smart things to do. Same thing with life insurance and health insurance, etc. Life changes. Kids grow up and go to college, they leave the nest. A house is paid off, you buy a new house, you have a new grandchild. Just think about those life changes and if they increase or decrease the needs you have for life insurance, disability insurance, health insurance, etc. Something as simple as an umbrella policy could be a life-saving financial move for you. An umbrella policy is also known as an excess liability policy. Think that, there's some ice out there and someone slips and falls in your driveway and sues you for 2 million bucks. Well, if you don't have an umbrella policy, you might be worried, but if you do have an umbrella policy, you're probably going to be fully protected whether they win or lose, which they'll possibly lose depending on the situation. So, umbrella policies are pretty cheap, but they could save you a million, 2 million, $5 million from a person who could potentially sue you for something that's completely out of your control. So just consider your insurance needs in any situations that have changed over the course of the last year or two. We talked about emergency fund earlier. Generally, we recommend having 3 to 6 months of expenses in your emergency fund. For someone making $4,000 a month, that could be a target goal of 12,000, 24,000 for emergency fund. We also recommend having your money somewhere that grows well. Often we see bank accounts paying 0.0 something percent. If your bank account's not paying at least 3%, might be a good idea to look for a better bank because there's a lot of banks that charge no fees, that have no minimums, that have no requirements, and they pay 3% or more per year, regardless of how much money you have in the bank account. So the emergency fund, having the liquid money is super important. But if it's going to sit there, it might as well earn a little bit of interest. So just check into your bank. And again, the bigger the pot you have in the emergency fund, the more important it is to consider some type of high yield savings account or some type of instrument, be that a bank account or a taxable investment account, that's going to give you a little bit more bang for your buck. As we think about 2026 goals, I would just encourage you to make the goal SMART. I always get caught up thinking about what it stands for: specific, measurable, attainable, realistic, time bound, something like that. But we don't want you to just say, I want to save more in 2026. We want you to say, hey, I want to increase my savings by $1,000 per month so that I hit my target of $15,000 in savings by June 2026. The more specific you get with your goals, the more realistic they are, and the more likely they are to come true. There's some power in manifestation where you illustrate and you paint the picture of what you want and you revisit that over and over. Those are the things that come true in life. So it could be as simple as just making your goals specific, measurable, and time bound. I think time bound is one of the most important things. I will accomplish X by Y date. Additionally, anything you're doing financially should align with your values, your goals, and they should just be things that are rewarding. We don't want to just save for saving's sake or just accumulate for accumulation's sake. Typically, there should be a reason. I save money so that if something bad happens, I don't have to worry about money and I can prioritize my family. That's one of the reasons that I save money and I strive for financial independence. Because on the drop of a hat, if I need to do something for my kids or my family, I want to be able to do that. So that's part of why I make the decisions that I make on the day-to-day basis. And, sometimes we don't get really clear on why we're saving. And what I found is the more clear we get on why we're saving, the easier it is to actually do the saving, which is sometimes not that fun. So just think about your goals, and maybe in 2026, you can make them even more clear and even smarter as you set forth in the new year. Whew. We are at the grand finale. So, your action plan. In review, there are several things we could consider and think about doing before the end of the tax year. That's increasing or maxing out 401ks or other contributions. That could be opening a Roth IRA to make sure you get credit for at least one more year. That could be having a plan for required distributions, reviewing and updating your benefit elections at work, making decisions with Social Security or Medicare, maybe tax efficient gifting or charitable strategies, scheduling a time to talk with your accountant and say, hey, how does the one big beautiful bill impact me? Are there any changes I should make before year end? Because often taxes are a lesson in history. We say, oh, what happened in 2025? Wouldn't it be nice to flip the script and say, what are we going to do going forward? Those are the best outcomes that I find when we look out of the front of the car versus looking out the back. So this could be a good opportunity to still do a little bit of proactive planning before the year's out. As we roll into 2026, review the goals, review the actions you took in 2025. Get really clear on the goals for 2026. Start to build and capitalize on that momentum, and then just make sure that you're ready for that first check-in that you have with your advisor. And if there's big topics or questions you want to discuss, make sure they know what it is so we can be sure that we're helping you make some progress. My final takeaway is this week, if you can, try to identify a small win. That could be a bite-sized action like printing your year-to-date credit card transaction history. It could be scheduling a time with yourself or your spouse or a friend to do a budget day, budget and brunch. Let's order some McDonald's, hash browns, and McMuffins, and let's go to work on our budgets. It could be anything, canceling a subscription that you don't need. Um, you know, Trading in that old cell phone that you don't need anymore, getting 500 bucks back to use towards holiday shopping. Those quick wins and those small wins add up to big wins, which help you get from where you are to where you want to be. So there's real power in those things. A few common pitfalls are to wait until the new year to new year, new me to get started. There's things you can start now, or at least you can lay the foundation to then be able to really launch in the new year. Another common pitfall is, decisions are tough. Sometimes we just make no decision and just stick with what we used to have. We call that satisficing when you just say, I'm satisfied with, the whatever I did in the past. And sometimes that's not the best thing. So if you don't have the ability or the desire to do it yourself, enlist some help. Maybe someone can help you review those things and make the changes that are best for you. I know we do that for folks. We'll call them working meetings, where together we'll pop on and click buttons and read together and just help you make some progress. Lastly, I would encourage you to think of things holistically. There's so many different parts to our financial life, be that protection strategies and savings and investing and estate planning and taxes. And if we look at them in silos, we can sometimes make decent decisions. But I found that the best decisions come from having our arms around the whole equation and looking at how each of these things impacts one another. I would consider that integrated planning. So let us be your partner in integrated planning. The more you share, the more we can help, the better outcomes we can achieve together. So I have next steps on there, and the next step is just start holiday shopping. I haven't done it yet. Just kidding. But the next step is if there's anything you heard that you feel like could benefit your situation, you have, again, 75 days or so left in this year. And hopefully some of those things can be foundational and building blocks for an even better 2026 and beyond. So that's all I have for today for our formal comments. Appreciate you sticking around and again, flexing with us as we had to switch our link for the meeting. I'm going to look at the chat box. Any questions based off of what we talked about today, or even questions that we didn't talk about that you want to ask while you have me? And while I'm waiting for questions, I'll just say what I typically always say, thank you. It's a commitment of your time to be here. We enjoy doing these things and we're ultimately hoping to provide value. So I hope you found some value in today's presentation. And 2026, we're going to do more of this and we'll be asking for your feedback. So please share with us the things that you want to hear more about. Flip, you're very welcome. Thank you for being here. Dick, thanks for being here too. Please bring them up to them, and you may even be able to tell them a couple things in advance so they can prep if needed. Of course, Ronald, thank you, thank you. So yeah, looks like there's no questions. Again, if there's anything we can do for you, please let us know. We're here to serve. We appreciate you, and I'll say have a good night, and we'll look forward to seeing you next time. Best wishes.